Planning on growing or scaling? You better have enough working capital. Don't know how to calculate that? You better watch this video. This is one of the most disorienting things a business owner can experience, and it happens more often than most people realize. The accountant says the business made money. The profit and loss statement shows a positive number. Taxes are owed on that income. By every traditional measurement, the business is profitable, and yet the owner is stressed about cash. Payroll feels tight, suppliers are waiting longer than they should, the bank account never seems to have as much as the revenue should suggest, and the owner cannot figure out why. If that sounds familiar, I want to explain exactly what is happening, because it's not bad luck. It's not a mystery. It is a very specific financial dynamic that accounting reports don't show clearly, and most owners have never been told or have it explained to them. The short version of this is cash and profit are not the same thing. And the business that is profitable on paper can absolutely be in a cash-strapped reality at the same time. Understanding why is one of the most important financial concepts any business owner can grasp. Let me start with how this happens. When your accountant calculates your profit, they are looking at revenue earned minus expenses occurring during a specific period. But that calculation does not account for the timing when cash actually moves. Revenue gets recognized when a job is completed or an invoice is issued, not necessarily when the customer pays. Expenses get recorded when they occur, not always when the cash goes out. So the profit number on the report represents an accounting reality. It does not represent your cash reality. And those two things are very far apart at any given moment. Here is a simple example of how this plays out. Your business completes $100,000 worth of work in a month. You invoice for all of it. On the profit and loss statement, that revenue is recorded. But your customers pay in 30 or 60 days. And that's your terms. So the cash hasn't arrived yet. Meanwhile, your payroll went out, your suppliers needed to be paid, your overhead keeps running. The business spent real cash to produce the work that hasn't even been paid for yet. The gap between that business earned on paper and what it has in the bank account is funded by working capital. And if working capital is thin, the business runs tight, even in profitable months. Now let me add a layer that makes this even more complicated. Debt. When a business makes loan payments, equipment payments, any kind of debt service, those payments do not run through the profit and loss statement and as expense the way most people would assume. The interest portion does, but the principal repayment does not. It comes off the balance sheet. It reduces a liability, but it does not reduce your reported income. What that means practically is this. Your business could show $50,000 of profit on its income statement and simultaneously be making $40,000 of principal payments on its debt. The profit and loss statement looks fine, but $40,000 of real cash went out the door to service debt that the profit number does not reflect. The business has a $10,000 real economic value after debt service, not the $50,000. But if you're only looking at the profit figure, you would never know that. I've sat with business owners and shown them this calculation for the first time and watched the expression on their face truly change. Because suddenly the thing that never made sense, the question of why a profitable business feels broke, all of a sudden now it has an answer. The profit was real, but the cash obligations sitting below the profit line were consuming most of it before the owner ever saw it. The third part of this is working capital itself and how it behaves during growth. Here's something that surprises most owners. A growing business actually consumes more cash than a flat one. Not less, more. Because as the revenue increases, the size of the gap between spending money and collecting money also increases. More jobs are in progress. More receivables are outstanding. More materials are needed up front. More payroll going out before the work gets billed and collected. So a business that is growing its revenue can simultaneously be tightening its cash position. A business grows from $1.5 million to $2.5 million in revenue in 12 months. The profit and loss looks great because the revenue is up. But if the working capital required to support a $2.5 million company is $208,000, and the working capital required to support a $1.5 million company was $125,000. The business needed to generate an additional $83,000 in working capital just to fund the growth smoothly. If that working capital wasn't there, the business funded the gap with debt, or stress, or both. The owner felt terrible the entire time despite a record revenue year. Now you know why. Let me explain what working capital actually is, because I find most business owners have a vague sense of it without a precise understanding. Working capital is the financial fuel your business needs to fund its operating cycle. Think of it this way. From the moment you start a job to the moment you collect payment from that job, there is a period of time during which the business is spending money it hasn't collected yet. It's paying for labor, buying materials, running trucks, covering overhead, all before a single dollar of that job comes back in. The length of that cycle, multiplied by what it costs to run the business each day, tells you roughly how much working capital that business needs to operate without running dry. If it costs your business $8,500 a day to operate, and your average collection period is 31 days from the point the job starts to the one you get paid, your business needs roughly $263,000 in working capital just to fund one operating cycle without borrowing. Do you have that amount in liquid assets right now? If you don't have it, you fill the gap, and that gap is filled with debt. A line of credit, a business credit card, a loan from the owner's personal account, whatever it takes to keep the wheels turning. And every time you fill that gap with debt, you increase the debt service requirement, which puts more pressure on the operation. That is a cycle I see playing out business after business across every industry. Not because the owners are bad at business, because they never had the working capital concept explained to them and in the way that connected to the daily financial reality of what they were experiencing. So what do you do with all of this? The first thing you do is stop using profit as your primary measure of financial health and start looking at cash flow and working capital alongside it. Profit tells you whether the business model works. Cash flow tells you whether the business can survive. Working capital tells you how much margin of error you have. All three of these together give you a real picture. Any one of them alone only gives you a partial one. The second thing you need to understand about working capital is not your cash balance, it's your working capital position. That means looking at all your current assets, the cash, the receivables, the inventory, things you convert into cash within a year, and subtract your current liabilities, the payables, short-term debt, or your debt service that you're going to owe within this year. The difference between those two values is your working capital actual. And comparing that to what the business actually needs to fund its operating cycle tells you whether you have a cushion or a deficit. Most business owners who do this calculation for the first time find out they're in a working capital deficit in most cases. This is why the business feels like it's constantly robbing Peter to pay Paul. That phrase is something I hear from business owners constantly, and it's always almost a working capital problem. Business doesn't have enough financial cushion to fund its own cycle. So it borrows. Then it pays back what it borrowed. Then it borrows again. And the owner just keeps running the cycle, wondering why the stress never goes away, even in good months. There is only one way out of a working capital deficit. Real after-tax profit, above the minimum mandatory level, that gets left in the business and allowed to rebuild the cushion rather than being extracted or consumed by other obligations. This is the connection most business owners are missing. Profit is not just a measurement of success, it's a mechanism by which a business builds the financial resilience to stop feeling broke all the time. When you understand that, the whole picture changes.